Welcome to Trading Nation. I'm Sara Eisen, joined now by Art Hogan, Chief Market Strategist at B. Riley FBR. Good to see you, Art.
Good to see you, Sarah.
So you say the next year looks pretty fantastic in terms of the stock market. You're not worried about the 10-year yield at 3%, rising rates and inflation, and a potential trade war?
I'm worried about all those things and trade war the most. I think a trade policy mistake is probably the biggest fear that we have in the marketplace right now, and rightfully so. What's changed on that front, though, it appears as though this administration likes to start out very forcefully and then work their way to a middle ground. Feels like we're making some progress on NAFTA. And certainly, if we can get some progress on NAFTA and get that renegotiated, I think that shows some promise for our negotiations with China. But I think the biggest fear that this market has in the clear and present is a mistake on trade policy. As it pertains to the rising interest rate environment, I think that's a natural outcome of what's going on in the economy. The economy is improving steadily. We've got a Fed that wants to normalize. We've got a yield on the 10-year that we're hyper-focused on because we're getting to a round number that we haven't seen in years. But I don't think that's going to be the detriment for the market.
So you think these solid economic fundamentals and corporate earnings can continue to propel this market?
You know, it's a story that's really not being told. We ignore the fact that we're going through an earnings reporting season where we're going to have close to 20% growth in the S&P 500 on 9% revenue growth. And we're completely ignoring the fact that estimates went up intra-quarter, are going up for the out quarters for this year. So the S&P is going to go from earning something like 136 to something like 156 to something like 174 in the out year. So I think that fundamental story continues to be very strong. And at the same time, we've got leading economic indicators in expansion, still in expansion in most of the globe, and a very solid labor market. So I think the fundamental backdrop gets clouded when we get concerned about a lot of the geopolitical events that are going on right now, especially as it pertains to trade.
You know, the bear case might be the fact that we've seen this global synchronized growth story. It's been on all the front pages. It's already in the market. We've seen the tax cuts already priced into the market. And in fact, stocks are lower since we actually got the legislation. In other words, that good news is there. And now people are wondering, is this as good as it gets?
Yeah, and that's fair. It's what's not priced into the market is what we always try to figure out. I don't think the tax cuts have certainly priced in. You know, for example, corporate America just now reporting their first quarter with a lower corporate tax rate. We're trying to figure out what that's worth and what kind of multiple we put on that kind of earnings growth and what that means. I think the first quarter also was benefited by a weaker dollar during the course of the quarter. So I think, most of the multinationals are doing much better than expected. But to your point, one of the things that's hard to know is has the market an efficient enough pricing mechanism to say, okay, we passed this in November, we've already priced this in the November to January pop, and the rest of the year is going to be flat. And I would argue that's probably not the case. I think we've got a lot of momentum in front of us, and the only impediment has been a fear of a mistake, either a monetary policy mistake or a trade policy mistake. And unless and until we disprove some of those things, we continue to face the headwinds that we ignore the solid fundamentals and pay more attention to what's going on in the news, in Twitter.
Is there something that could change your mind? Is there a level, if the 10-year hits a certain level at a certain time, for instance, that would change your mind?
I think that's the best, Sarah, that's the best way to ask that question. It's in time, right? So the first time we freaked out as we got close to a 3% yield on the 10-year was because we added 47 basis points in a period of 5 trading days. So if we gradually, sort of are in a range of 2 3/4 to 3 1/4 this year, I think that the market's going to be fine with that. I think we start running into significant headwinds in a 3.5, 3 3/4 in a short run. So if in the next 12 months we were to see 3.5 or 3 3/4, that might start setting up some caution flags. But right now in the current range we're in, the three is not a line in the sand, and it's not going to be an impediment for markets. I think we can be in a 2 3/4, 3 1/4 yield on the 10-year range for the balance of this year and be fine.
Within your optimistic view of the overall market, which industries, which sectors do you like the best?
Well, I'll tell you the 3 sectors that will probably be leadership this year will be financials if we get any steepness whatsoever in the curve. I think that's going to occur.
But we are seeing
as
that,
we head
Art,
into the summertime.
and the financials just can't catch a bid.
Okay, Morgan Stanley, Goldman Sachs, JP Morgan puts in a great report, and then all of these stocks get sold. And I think that alludes to that sell in the news mentality you were just talking about. How much of this is baked in? I think this, as we sort of saw with the financials that reported on Friday, sold off on Friday and started coming back into the money on Monday, Tuesday, Wednesday. I think it's going to take some time for us to accept the fact that their earnings power of the banks hasn't been priced in. You got most of the major money center banks that are trading at call it 1.5 to 1.75 of book value. I think it should be something north of that. And I think that, the financials overall are going to be beneficiaries of a higher interest rate environment. They have historically. We get some spread in that, and that's even better. They're certainly beneficiaries of tax reform. I would also offer up that I think industrials, mid-cycle industrials, are a strong play here. And I certainly think energy, and energy probably has an equity complex that's lagged the commodity complex. We've seen a significant move in energy prices. We haven't seen the same move in the equities behind that complex. And I think energy, in terms of a global commodity, is coming into balance a lot sooner than people thought it would. Came into balance in the first quarter of this year. So I think the profit margins are going to increase for most of the domestic E&P plays this year, and I think that they're still relatively well valued. The flip side of that coin, though, is what do you avoid? If we're in a rising interest rate environment, look at consumer staples. I think you brought that up in your last segment. I think one of the worst performing sectors this year. I think the same thing is going to be held true with all the bond surrogates, whether it's the staples, the telecoms, the utilities, or the REITs. So if you're overexposed to some of those dividend products, those bond proxies, those dividend darlings, I think that's where you want to start thinking about rotating out.
Stay cyclical is your message.
Stay cyclical. I think we've got a strong economy, a strong earnings cycle, and I think that we're still in early days here. A big policy mistake could bring all that to an abrupt end. If we continue, with protectionist policies and continue to think that somehow using a trade balance as a report card is a good way to set policy, that's not going to work. But I think if we can get to the negotiating table, get NAFTA reinstated, and get to the negotiating table with China, we'll put some of this behind us and start focusing on fundamentals again.
Thinking positively. We will end it there. Art, thank you very much for joining us. Art Hogan of B. Riley FBR. And thank you for joining us and watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.